All right, well, good morning. I'm really excited to be a part of your entrepreneurial journey. And today we're going to talk about how to get funding for your startup. And at the end of the day, let's face it, money is the fuel of most businesses, right? So I think this is going to be a pretty important subject as you guys move forward. Back here. What I'm going to do is I'm going to hit you with an overall summary of my presentation. And then I'm going to go into the specifics of each of that. And then I'll finish with the same summary again, so you can see the overview of where I'm going. And most importantly, I welcome interaction. Interaction is a lot more fun than me just talking for an hour. So if you have a question, please, if you see you want to go in a little different direction, it's your material, it's your presentation. I welcome that opportunity to interact. So let's kick things right off. How to pitch to a potential investor. And of course, you're going to start with your value proposition. And I think most of you have got that pretty well at hand. And the thing I'm going to say again, you've got to, in a very short statement, explain why is your startup unique? Why is it defensible? And does it disrupt existing markets? One of the other things you're going to be asked to comment on very quickly by any potential investor is AI your friend? Is AI your foe? How will you use AI? Will AI eventually be a disruptor to your business? So you'll have to absolutely have some talking points as to how you'll embrace artificial intelligence. Now, we're going to get specific on making a request for startup capital. And I'll talk about a couple of different ways: friends and family, crowdfunding. I believe for many of you, the convertible note may be the best place to start. And we'll also get into angel and venture capital, because at the end of the day, all roads will go to venture capital if your company is to really expand and scale up. Now, when you target investors, you just don't simply go out and ask for money. You want to target investors that have expertise in your market. The closer you can align yourself with an investor that might have a personal or a business interest in what you're doing, the opportunity for a relationship is much greater. And so we'll talk more about that. And also, be prepared for rejection, okay? This is not easy. It's a game of numbers. You might end up having to talk to 20, 50 people before you finally get funding. But that goes with the neighborhood, and you just have to be strong, have to believe in your ideas. You've got to explain, how will you use your investor capital? How much do you need? And do you require any expertise from the investor? Investors often, again, because they focus on certain markets, they're experts in areas that you want to get into. It's fine for you to try to leverage that experience. And often they're farther ahead than you are in terms of knowledge of that market space. And so the investor is more than just a pile of money. They can absolutely be a key partner. You're going to have to forecast and defend your revenue estimates. Very, very important. What I've seen so far, and I like this, most of you are using independent TAMSOM market forecasts. Very, very important, because you get in front of an investor, everybody thinks they have a good idea. Of course they do. But what the investor wants to see is, okay, show me some independent market research, unbiased research that suggests that you're getting into a marketplace that's large and something that you can compete in. Investors love customer feedback. And if you ever have even some sales or trials, surveys, very, very helpful, because again, the belief in venture capital is that the customer is king and the customer doesn't lie. The customer votes with their pocketbook. Somebody walks in and says, I've got a certain amount of sales. That's an indication that some number of people believed in your value proposition, or they're willing to pay. And so the more that you can show that you've got experience in working with customers, and there's an old saying in Silicon Valley, never start a company unless you know your first customer. So absolutely, you're going to be asked to defend and understand your customer base. Show a path to profitability. You won't be profitable overnight. Might even take a couple of years. But you really need to say, hey, What's the road look like? How much and when? For some of you, you're going to have to focus on cost of goods or services. That will often define at what point you become profitable. And don't forget customer acquisition costs. Very, very important. Lastly, if you're pursuing a venture capital type program, you're going to have to explain your valuation assumptions. And we'll get into that. And valuation is basically, what is your company worth? So I've reviewed the pitch decks. And again, I think you guys are all off to a great start. And what's really the next step is we need messaging. How do you ask for startup capital? So early on in your presentation, you must address how much money do you need? Very simple statement. And how will that money be used? Very, very critical. And you may also want to include what are some of the key milestones that you need to achieve to execute your business plan. Now, nothing is free, right? So often equity is exchanged for capital. And so equity is just the value ownership of a company or a startup. So just very simply, let's say you're a startup and you give away 10% equity of your company for $100,000. A couple of years later, the company makes a $2 million profit. Well, the investor that owns 10% would get 10% of that $2 million or $200,000. So when you give up equity, you're giving up a little bit of your company. Now, again, you can't keep it all. You're going to have to do some exchange, and we'll talk about some options that you have. But at the end of the day, this is typically the path that you take. The danger is if you give up so much equity, you may lose control of your company. So when someone has 10, even 20%, they get some say, they get some opportunity to be a part of your decision process. But at the end of the day, you still maintain control. I wanted to pull out a slide from Access Care, and I was very pleased that they have, which is probably a little bit of a placeholder slide, but they've got the right title. How will the money be used? And so what I'd like to offer some ways to bring this up to another level is, first off, we need the dollar amount. Specifically, is it 500,000? Is it $1 million? Whatever. But we're going to need to start off with how much it is. Now, we're really going to need some specifics here. Product and development, operation staff. These are all generic terms. When you're dealing with an investor, you need to be as specific as possible as to the money that you need and how you will deploy the capital and some of the key milestones. And this is a great slide for the initial pitch deck. Then what you should have in the appendix is under each one of these, you're probably going to have another slide which will drill down on, okay, product development. What does that entail? Is it hardware, software? Do you need to get involved in some manufacturing? Under marketing and customer acquisition, how will you find your customers? Are you going to go online? Are you going to go retail? Are you going to work with distributors? There's a lot of information there that you're going to have to be able to drill down to be specific. But again, as I'm going to talk about it, you need to talk to a VC or an investor in layers. You can't hit them with the entire thing at once. This, as a top slide, would be very effective once we put in a few more specifics. Now, this is where we're really going to get to kind of the meat of today's presentation. I would argue that where you are in your presentations and your journey of entrepreneurship is you're looking for seed capital, early money to just basically get your business up and started. And there's a couple of ways to go. And as I say, all paths eventually will lead to venture capital. And we're going to talk about venture capital. Do I see this group initially, day one, going in front of a big VC up in the Bay Area? Probably not. You're probably going to need to take an interim step, which I'm going to talk about first. But at the same time, if you approach some of the earlier methods the same as you would a venture capital fund, it'll put you in good stead and will get you ready for that eventual discussion. So first off, you can do a friends and family loan. Hopefully they'll still be your family and friends after it's over. I've seen cases where it can get a little different. It's capital in exchange for interest or future equity. Crowdfunding. I like crowdfunding for a lot of early startups. Now, when you do crowdfunding, there's a couple of things. Obviously, you're going to get money in exchange for what? The most common two are equity or capital in exchange for future services or discounts. I'm going to tell you up front, do not do crowdfunding with an equity exchange. It's a bad deal for you. It creates a lot more complexity in the process. And if you're going to go that route, go to a convertible note. But what I really like is when you do crowdfunding in exchange for a discount or future services. Now, crowdfunding is a very good fit when you have a product that has a relatively low cost, but it's to be sold over many, many, many thousands or hundreds of thousands of customers. And when I looked at your different programs or teams, one possible fit was Bash. Why I think this is a good fit for crowdfunding is once they establish and do the development work, get the app up and running, get their contract players in place, the actual incremental costs for each customer is pretty low. Compare that to, say, if you're an automobile company, well, every customer requires the sale of a car. That's a very high capital intensive effort. But once they get up and running, they have a low incremental cost. Now, one of the other nice things about crowdfunding is that in theory, you have a built-in customer base. So let's say Bash successfully went out and said, we're going to sell the opportunity to use our service free for a year in exchange for a $100 investment. So now let's say they get 1,000 people to sign up. You've got $100,000. But more importantly, you've got 1,000 people that are probably likely to use the product. So it's sort of a built-in free customer acquisition cost. And hopefully they have friends and, you get the multiplier effect. But for a lot of cases, the crowdfunding is a pretty good way to go. And I would say typically, crowdfunding works up to about 100 to 200,000. The negative with crowdfunding is you throw it out there and you may get some early money, but you don't really know what it's going to look like over time. Much different than when you go to a convertible note or a venture capitalist. If you're successful, you'll get the total amount of money in hand at once. So the crowdfunding is a little bit more challenging, but it can be a good fit for some of you. Also, as I'm going to point out, you can do multiple funding processes before you go to a venture capitalist. So for example, convertible notes. Convertible notes is basically, and we're going to get into the specifics here, it's a structured loan with interest that converts to equity at a discount. And typically in a couple years when you start to go for Series A funding. This may not make a lot of sense right this minute, but I'll explain later. One of the nice things about a convertible note is it avoids you having to get into a discussion of valuation. Valuation is, what do you think your company is worth? That's a very contentious discussion. It's difficult. And the convertible note sort of kicks that down the road a little bit because it says, hey, when you eventually get Series A funding from a venture capitalist, you will have a valuation and will convert, and I'm going to get a discount. Now, it's perfectly acceptable to say, hey, I'm going to try to raise 100,000 with a crowd fund, and I'm going to go ask for a couple of 100,000 with a convertible note. You can do that. But by the time we get ready to talk to a venture capitalist, this has all got to be behind us. Okay, you don't go to a venture capitalist and say, also, I've got a crowdfunding program in parallel. I will also tell you, when you start talking with the venture capitalist, if you had a successful crowdfunding effort, that is a big feather in your cap Because again, crowdfunding proves that there are customers and that there are people willing to invest. And as I say, it does kind of give you a built-in customer base. Venture capital is a highly structured arrangement, and it's capital based on equity as a result of valuation. May not make a lot of sense right now, but I promise you we're going to get into it, and hopefully you're going to walk out of here a little bit more, a little smarter about what that entails. So let's talk about convertible notes. Again, it's a short-term loan that converts into equity at a future date, and it typically converts when you raise VC funding Series A. Now, in your pitch deck, after you've done your value proposition, you're going to want to say something like Team X requests X millions of dollars or whatever in a convertible note. The interest rate typically varies between 2 to 8%. You can pick a number. It'll be negotiated, I'm sure. With an X year maturity typically in a lot of small startups could be 2 years, 3 years, something like that. Not more than that, because it's a convertible note. A convertible note implies that this is a stepping stone to more capital in the future. So you don't want to put in a 5-year maturity date, because that's a long time for a small interim step. Typically, as I say, 1, 2, 3 years is what you would see. And then when you eventually, shall we say, incorporate and establish a valuation, what's in it for them is they're going to be able to buy shares at a discount. And it's sort of a win-win for both sides. So in the mechanics of a convertible note, Team X receives a certain amount of capital, and initially it's a loan. Let's just say prior to maturity, and so let's say they ask for a 2-year window, and after 18 months, Team X raised a certain amount of money via Series A venture capital. And as I pointed out, a convertible note is an interim step before you actually try to achieve more formal Series A venture capital funding. The investor will apply principal interest to purchase equity at an X% discount rate, whatever you've decided, and the loan is dissolved. In the world of convertible notes, rarely are investors paid back with principal and interest. If the investor sees the startup is struggling, you're not going to be able to hit the milestone, or maybe you need more money, often the investor will come in and extend the terms to try to keep you running, because they have more invested, they have more to gain by you being successful. And technically, if the whole thing goes belly up, there's nothing for them to reclaim anyway. So it's in their interest and your interest to try to figure out how to keep going forward. So as I've said, friends and family, crowdfunding, convertible notes, and what is an angel investor? An angel investor is sort of a venture capitalist, but it's normally one person. They are a little bit softer, not as structured, but I often would approach an angel investor as I would a venture capitalist. But normally, once the angel investor gets a company up and running, you really want to go to a full-fledged venture capital. Now, first thing is, venture capital companies, they come in all sizes and shapes, and VCs will often fund convertible notes. So that's, also a good place to start. So let's talk about venture capital. A startup would typically receive early seed funding via the methods we just talked about. And then you go and do a Series A funding via venture capitalists. And typically the things that you're looking to accomplish in Series A is a production-worthy product or service, establish recurring revenue, and you're probably going to have to give up 15 to 35% equity in exchange for the capital. Now, once you get engaged with a VC, and again, when you're giving up 25, 30% equity, they will want to have some formal relationship with you. They may want to have a board member. They may want to have someone on your management team. They will become a very integral part of your business. And ultimately, in Series A, the goal is to get the company to the next level. rarely is that sufficient for the VC to say we're done. It's really to get you to the next step. And so you may be seeing in the press and things, there'll be future rounds of funding as the company needs to move up. You'll have what is, Series B, C, D. In the case of Uber, they had 26 rounds of venture capital funding before they did an IPO. So what's also very important, every VC, and this is true, and even in your personal life, if you ever make an investment, whether you buy a stock, help out a friend or whatever, the first question you should ask yourself is, what is the exit strategy? What am I doing with this investment? And the VCs are no different. And so they're going to want to understand, hey, where are we going? What's the time frame? And then how do I get my money back? Most cases in the space of venture capitalists, mergers and acquisitions. You build a great company, you establish profitability, you have a nice valuation, and a much larger company decides to make you an offer and buy you out. That is typical of what most of the investments, that's the path they take, and it's a good one. Now, a lot of people say, well, I want to do an IPO, initial public offering. That's a big task. I'm not saying that it doesn't happen, it does, but it's way, way less. And, IPOs are incredibly expensive. They need very large scale. Certainly, no one in this room should be presenting to a VC and saying, yeah, our exit strategy is an IPO. But what is important is what's your time frame? We're going to get into some specifics on that. Now, venture capital is more than money. Okay, this is often missed by first timers. They look at venture capital as purely a place to get money. They have a tremendous amount of technical and managerial experience. And so they often, especially some of the larger companies I work with, like, for example, Sequoia, if you ever want to do a Google search or know them, they're one of the big VC players up in the Bay Area. They have hundreds of portfolio companies under their investment. Often, when someone's pitching to them, they'll say, I think you've got a good idea, but I've got another company that's doing this, and I think maybe you two guys could work together. Or I see some intellectual property over here that I think would be appropriate to you. And so that is definitely an opportunity for you to get out beyond your own expertise. And it's something that's often lost on people. When you get involved in VC and venture capital, it has changed dramatically. When you look back between 1960 to 2000, typically a venture capital would come in and fund a company in Silicon Valley for 3 to 5 years. But that's radically changed. After about 2010, for example, Uber was under control of the venture capitalists for over 10 years. And so the relationship, when you decide that I'm going to invest or I'm going to work with a venture capitalist, this is a long-term journey, and you need to be prepared, for 5 to 10 years for success. Now, I wanted to bring this up because I don't know if anyone has seen the Netflix. It's a quasi-documentary called Super Pumped: The Battle for Uber. It's the only movie I know that actually has a venture capitalist in it, and the venture capitalist is shown as sort of the only adult in the room. You had Uber with this eccentric founder and all the craziness that goes in startups. The venture capitalist was the person who constantly had to come into the meetings and say, you've got to hit your deadlines. You've got to hit your milestones. What is the next key deliverable? And so ultimately, it's really not all wonderful. You'll often find that the venture capitalist has to be the bad guy. He has to be the person who really insists that key milestones and goals and sticking to the financials are kept. Now, VCs, it's all about valuation. So what do we mean when we say valuation? Well, it's pretty simple. Let's just take a publicly traded company like NVIDIA. And if we just look at their market capitalization, which is we look at the stock price and the number of shares. So NVIDIA right now has a market cap of 4.4 trillion. That's 182 a share. They have 24.2 billion outstanding shares. Now, in theory, if you had 4.4 billion or trillion in your pocket, you could buy NVIDIA. And basically, they're saying that's what the company is worth. Now, NVIDIA returns $5 per share in income, profit. And based on that, the stock price, when you divide it by the earnings, it has a 36 times multiple. So basically, what you can take away from this, and we're going to get into it in a little more specifics, you look at your company and see how much income are you producing, what multiple do you think your company can achieve, and that will come up with a valuation. And we're going to see why valuation is everything. And I think it really works better with an example. Yeah, it's like my formatting got a little messed up here. Okay, so let's walk through a simplified Series A request to a venture capitalist. So first off, you walk in, you share your value proposition, and you say, I need $1 million to start my company. I believe this investment that I'm going to share with you has a 5-year exit or termination. I believe at the end of the 5th year, I will achieve 10 million in revenue. At that time, I believe I will be 30% profitable. So after tax, so you look at that 10 million revenue, and if you're achieving 30% profitability, that means your income will be 3 million. Now, if I believe my company should trade at a 15 times multiple, which is a pretty good number for a small startup, it's a good place to start. Your 5th year company valuation would be 45 million. Again, that's just simply the income times the multiple. Now, VCs, they're not in this just to be your friend. They're in this to make money. They're going to come back and say, well, for a 5-year period, I'm going to want a 10x return. So they're going to put up $1 million, and at the end of those 5 years, they're going to want 10 million back. Well, if your company at the end of the 5th year is valued at 45 million, and they want 10 million back, you're going to have to give up 22% equity. So this is how you basically lay out the foundation of your company. And you have to kind of work this through. And it really helps to have this on a spreadsheet. You can do a lot of what ifs. But then let's just take a look. Once we've done this, let's see how this looks when you're doing a presentation deck. If you're going after Series A, again, you'll start with your value proposition. And then it would say something like, your startup asks for 1 million in return for 22% equity based on a 5th year valuation of 45 million. Now this is music to the ears of a VC. That's how they want to be talked to. This is your opening line. So when you're doing your deck, you've done all this back work, but this is how you're going to start off. Hey, I've got a great idea, and you know what? I need $1 million in return for 22% equity with a 5th year valuation of 45 million. And then the VC is going to say, okay, what are you going to do with that million? How did you arrive at a valuation of 45 million? Okay, so let's just go through this again one more time. First year, the venture capitalist invests $1 million. The 5th year, the company valuation is 45 million based on revenue and profitability. And so in that 5th year, the VC exits with 22% equity, so they have 10 million. The startup founders, they split the 35 million, which is 78% equity of the 45. Often, sometimes the founders may have to share some equity with seed investors if they have some other encumbrances. So again, the VC makes 10x on their money over 5 years, and that's a compounded annual growth of 59%, which is a lot more than a bank will give you. And that's why venture capital is attractive. But something I want to point out, a VC likely made 4 other investments at the same time at $1 million each, and all 4 likely failed. So really, at the end of the day, they put up 5 million across 5 different businesses. One popped, and they end up getting 10 million back. Their CAGR is 15%. So, it's a game of numbers, and hopefully they can do a little better than that. But venture capital, they absolutely, that's why they can be a little difficult, because they've got a lot to lose and they have their bets spread over many different companies. So does that make sense? Do you follow that? That's very important that you sort of just see the basic math of how you're going to approach investors. Now, I'm going to take a drink here. Talking to investors, and especially in the VC space, I like the analogy. It's like peeling an onion. You can't just go right into the center and expect to get the money. The process is you've got to go one layer at a time, and it's very important that you not over communicate early on, and it won't really give you any value. So you're typically going to start off with an email blast or whatever social media that you can use, LinkedIn, whatever. You're going to want to have a 4-sentence introduction to targeted investors. Value proposition, but if you can really do a good job on number 2, why you believe this investment is appropriate for this VC or investor. The closer you can show some commonality, the more they're likely to want to ask to hear more. Very clear that you make a capital request and share the founder credentials. This is about all you really want to do. You just want to drop the fish hook in the water, a little bit of bait, and you want to get someone to nibble. What you're hoping is that all you're going to get is, hey, the investor agrees to hear more. When they agree to hear more, you typically would share a 1-slide valuation pro forma, and the ultimate goal is to get a request for a 30-minute presentation. You're not going to start out with, hey, I want to come present to you my idea. You first have to share with them, hey, this is what I'm doing, this is the amount of money I need, and this is why I think you would be a good fit. They come back, and you then may share a little bit more detail, and your goal is to get that 30-minute presentation. And that's where the decks that you're working on today, and at the completion of the program, that's the deck that you want to be ready to present. And it has to be, again, an overview of your product that will basically condense to about 30 minutes. But I wouldn't be surprised, and I've seen this, you may come in with 10 slides that are really appropriate for the meeting, but you may literally have 100 slides in the appendix that will back up each of the things that you're talking about in the overview. And then depending on the needs of the VC or investor, you may be asked to comment. But ultimately, at some point, the investor will then decide on the next steps. So let's talk about how do we present to an investor. So the top slide is state your value proposition and highlight why your value proposition is unique, defensible, and disruptive. Now, I'm going to take a moment and put in a plug for 2 books that I believe everybody needs to have in their arsenal if you're going to go down the entrepreneurial road. The first one is called The Innovator's Dilemma. And what it talks about is how businesses disrupt and become famous, and how some businesses fail to make the change. Some great examples of disruption was Kodak was the world's leader in film photography, thought that was okay, and lost the entire market to digital photography. They were disrupted. Give Tesla a lot of credit. At that time when they started, pretty much everybody drove a gas-powered car. Tesla showed that an electric car is a very viable alternative and has significantly disrupted the market. There's a lot of terms that get used, and this book will go through examples. Clay Christensen, it was written about 20, 25 years ago, but it's still extremely relevant. And I guarantee you get up in front of a formal VC, they will have read this book, and then they will understand the terminology. So it's very important to explain, hey, why you're doing something new or different and how you may be disrupting existing markets. We use the word defensible. Why is that important? Well, let's say you come up with a great idea, but it doesn't have any intellectual property, it doesn't have any patents, it doesn't have anything really unique to you. And there's another company that's been well established for many years, and they say, well, that's a good idea, we'll just copy it. And you're out of business. And that's something that an investor wants to know. You may have a good idea, but is it defensible? This is a book by Porter, and it's used in all business schools. And he talks about how to build a moat around your business. And that's often the terminology that's used. How do you defend your business against others that may want to try to knock you off? And again, early on, you don't have a lot of capital, so you could be prey for a larger company that's basically well invested. That's really a challenge. And so it's very important that you try and explain what you bring to the market. And as I've said before, you've got to explain how you're going to embrace AI versus becoming disrupted by AI. Very, very important. Now, after you've got the basics of the value proposition established in the slide, you're typically, assuming we're going to go for a convertible note or going right to a venture capital Series A, you would typically start off with a line like Team X requests $250,000 in a convertible note, 5% APR with a 2-year maturity and a 25% discount rate. That's how you ask for a convertible note. Or, as we just pointed out, in a venture capital space, Team X requests $1 million in return for 22% equity based on a 5th-year valuation of $45 million. These are very concise. They pack a lot of information in a very small couple of lines, but they're critical. And so when you start off with a slide like this, you actually are somewhat compelling to an investor because you're explaining the business and then what is it you think you're going to need and what's in it for them. So I wanted to give an example. In Bash, they say AI's role in Bash. And I think that's a good start in that I think every deck has to have a slide to say, what are we doing with AI? Can we get in, can we embrace it? Can we use it to our advantage? And also, what's not as clear here is how will AI not kill us, right? There's a big fear right now in software-based products that AI can simply come in, give it the same credentials and attributes of your app, and it will create an app to do the same thing. And that's why companies like Adobe and Microsoft recently are really struggling in the stock market because people are afraid they're going to be disrupted by AI technology. So very, very important. And today, even the most unsophisticated investors, they're all scared of AI. And you've got to do a little bit of work to show them that you're embracing it, you're not afraid of it, and here's why you can succeed with AI and not be disrupted. Now, going on with this template for a presentation, slide 2. Why do you need the capital? Okay. You start off with, hey, I need $1 million or whatever. Got to keep it to a 1-page overview. And typically, why you need money is product development, a minimally viable product, followed by, production-worthy service. You may have to recruit some critical talent, license key technology. There's a lot of things that, each one will be unique to each group. But people want to know, okay, how did you arrive? You may say, I'd like to have $1 million to start my company. Well, why didn't you ask for 500 or why didn't you ask for 1.5 million? You need to get pretty specific as to how you achieved that number. Now, this doesn't apply as much to you, but I wanted to just say, when you're up in Silicon Valley and you're asking for money, you need to leave enough for a small salary to live on. Now, just something to keep in mind. You could be a really, really good software designer, and your market value may be $500,000 if you were to go get a job somewhere at Microsoft or Adobe. If you want to go start a startup, the startup investor, the VC, is not going to allow you to take $500,000 a year in a salary. They're going to cut you to the bone, and they're going to say, well, what do you need to keep the lights on at home and put food on the table? And maybe it's $100,000. The reason is the VC wants the company to be as hungry as they are. They want everybody to have focus on growing the valuation and growing the equity of the company. So something to consider, because again, if you're going to start up a company, and often that'll be your job, you do need to leave a little bit for a salary. And as I say, the salary really has to be quite minimal, because investors want to see the founders motivated by valuation growth. They don't want them too comfortable, because if they're comfortable, they're not as motivated. And at the end of the day, we're looking for an exit. We're looking for a way to grow this company and make some money. The last thing I'll bring up, startups sound fun, and they are, and I've been a part of them, but they're a 24/7 lifestyle. You know, it's not Friday at 5 o'clock and you're done and you're going to go out and have a great weekend and start back up on Monday morning. You eat, live, and breathe that startup 24/7. There really is no downtime. And it's not always for the faint of heart. It's exciting because you have control. You're in this because you want to make a difference. You want to see the benefits of your own wisdom and hard work. But at the same time, there's no one there to help you, to protect you. You're always on. It's a very intense effort. Now, I also brought this up earlier, which is when you're talking to investors, it's critical that you target ones that are focused on your market, and it's a great opportunity to try to build some mutual relationship early on as to why you believe they're a good fit. Things you may need. For example, let's say you have a product that needs to go into Home Depot, Lowe's, or Walmart. Well, there are venture capitalists that have relationships with these companies, and they can get you an audience with these buyers. Things that you could never do as a small startup. That could be a huge, huge value. Also, you may have a gadget or some type of a device that you're going to make, and you'll manufacture prototypes in the United States. But at some point, you're going to want to go offshore and do high volume manufacturing, probably in China. The VC probably knows many good contract manufacturers could get you a relationship there and get you a very good deal. So look for what you need and think big. And if you get connected with the right investor or venture capitalist, they can open up doors you would never be able to get into. So in our mythical template here, after we've said, okay, I need this amount of money, I'm going to offer up this exchange, I could use a little help or expertise in this area. The next thing I want to share with you, my revenue forecast. Now, begin with customer trials and feedback. Again, venture capitalists, investors love honest, real-world customer feedback because ultimately it's a third party, and third parties have more validity than you just up there saying, sure, we're going to get 1,000 customers, X, Y, Z. And as I said earlier, never start a company without knowing your first customer or class of customers. And a customer can be anything from online, retail, it could be business to business. There's a lot of different ways to play this. And I wanted to basically share an example that I really liked with EcoPlate. They start off by showing that they've done in-person surveys of 220 UCI students, and then they're showing the results of that data, okay? That is extremely important. And then what I would expect is all the specifics around this would be in the appendix. But this is what you need to show when you're starting off saying customer trials and feedback. Next, third-party market size assumptions. This is an example I like because, again, some of you have your TAM, SAM, and SOM. And up here, they're quoting IBIS World 2025. The whole validity of this slide is based on the third-party TAM, SAM research that you've decided to cite. The belief is that these third parties do not have bias. You have bias. Your product is great. You think you've got the world on a string, and hey, good for you. But the investors and the VCs, they want to see how did you arrive. Now, your SOM ultimately will be your own assumptions. No one's going to give you a SOM number for a company that doesn't exist yet. But TAM and SAM, wherever possible, you want to stand on third-party research, and you want to tout that as a big part of your story because it shows independence and shows that you're not biased. In the revenue forecast, revenue is basically two things. You need to have price and the volume that you're going to sell. And so you need to start saying, well, okay, I'm going to sell my product or service for XYZ. And then you should have a comparable offerings slide or information as to where you came up with and why you think you're competitive. And then, there's a lot of different ways to look at this. Possibly your price may be higher than the competition on the assumption that they're going to save money long term. So you have to be somewhat, creative about where you're going to come up with this. In my example, I said in the 5th year, we're going to sell at $200 a unit. We're going to have 50,000 units, and that'll give us a $10 million revenue. And basically just trying to show a chart of what that growth would look like. And again, for a lot of companies, depending on the type of goods and the product, you may not really start to see profitability or large revenue gains until the 3rd or 4th year. That's not uncommon, but it's okay. You don't have to, no one is expecting you day one out of the chute to start making a profit. Profit is the last thing that comes in a business. Now, another example of nice examples of price and revenue, Scalera has shown up here, price per year on the left, and then they show what they think the revenue based on the number of customers or students. And same over here, I like this because it, again, starts off with, okay, year one, 144,000. How did they get that? 5 schools, 800 student users, $15 a month. Very logical, but that's what's got to be there to back up your revenue. And your revenue, if you're asking for a 2-year convertible note or a 3-year VC exit strategy, you've got to take your revenue at least out to that point, to whatever your maturity date that you're asking on the money. So, profitability. Now, in a convertible note situation, and you're only asking for maybe 2 years of maturity, you may or may not be profitable at that time, but you need to be showing a path to profitability. Now, in the example that I gave for my VC, I'm looking at the 5th year. In most cases, if you're going to go out 5 years, you should be profitable. So let's just see how this whole thing sums up. So on the 5th year, the revenue, we had 50,000 units at $200 a unit. We basically had $10,000 in revenues. And that was from the earlier slide. What's new on this slide is the cost of goods. Whatever gadget or unit or service, the cost of goods is $105. That's what it's costing us to make. So that's $5.2 million that'll have to come out of the revenue. Customer acquisition costs. We estimate $15 to get the customer, whether it's advertising, online search, etc. And that's another $750,000 that we'll have to pay out. And so, overall, you're looking at $4 million, and then you deduct the overhead. You have $3.75 million at a 21% federal tax rate. Your net income, what you can put in your pocket, is basically $3 million, and that represents 30%. So this is what you need to be able to explain, is how do you see your path to profitability? And your customer acquisition costs are very, very important. And you need to be able to explain how you're going to go down that and, what are some of the obstacles. Now, if you're going to do VC funding, what I said earlier was you're going to need to find a way to evaluate your company. And probably the best way is using a PE multiple. This chart, I'll leave it for you to look at on your own. But typically, when you go back and say, I've got net income of 3 million, and I believe that I trade at a multiple of 15, and different product sectors will have different multiples. And for example, what's the justification for a high multiple? Well, technology, because you have high growth, high profits, and in the case of software companies, very low overhead. You have a lot of intellectual property, very defendable. So you typically get a little higher multiple. Lower multiple might be something like automotive, because each car is going to require a very high cost of goods, and overhead requires a large brick and mortar presence. And so it's very interesting. You take Tesla. Tesla works very hard every day to tell you they're a technology company. They are not an automotive company. Why? Because the PE up here is probably almost 2x here. And that's why they want to be thought of as a technology company in the investor space. And so again, you can go online and you can see typical PEs for the different areas, and you've got to find one that kind of matches up with what you're doing. But if you're not sure, you want to start small. And by the way, when you look at a PE for a public company, that company's already established, they're already profitable, there's a lot less risk in that investment. And so by definition, their PE is going to be higher. You're a nobody, you're a startup, you haven't proven anything. So typically, 15 is a pretty good starting point. And a lot of VCs in their head, they may even discount that. They say, well, these guys would be lucky to get 10 times earnings. But those kinds of numbers, 10 to 15, look out and say, hey, when you become profitable, whatever that income is, and then you look at what market sector, what do you think a multiple would be, which 15 is not a bad start, that tells you the valuation of your company. And that's very important, because as you want to go down the VC space, valuation is everything. Then they'll decide how much equity they need of that valuation for it to be a good investment for them. So let me summarize things. And again, for many of you, I think the convertible note is a good way to go. And I really like this. I stole this, of course, from the internet. And it's basically showing the exchange of a great idea for money. And I think it's very appropriate. So what did we get out of this? You begin with your value proposition. It's important to explain why you're unique, defensible, and or disruptive. And you need to comment on, is AI your friend or foe, and how you're going to endorse it. Next, very early on, you need to make a request for startup capital. Friends and family, crowdfunding. I like crowdfunding for up to about 100,000. Convertible note works very nice, and typically, if it's 500,000, that's a very good number. And then, if you want to jump right in from day one, you could go to an angel or venture capitalist, and you would typically, to be of any real interest to them, you're probably going to need at least a request of 500 or a million, 500,000 or a million, and the revenue that should be associated with that kind of a startup. But very early on, you're going to have to make this choice. And as I've said earlier, before you go to a VC, it's quite fine to say, hey, we'll try to get 100,000 with crowdfunding, and then we'll try to go for 400,000 or 500,000 in a convertible note. You can do both of those in parallel, and the deck that you use for crowdfunding is quite similar. What the only difference is, the opening statement is for a certain investment of $100 per person, what service or goods are they going to get in exchange? And as I've said, do not exchange equity in crowdfunding. That is not a good way to go. Very important that we target investors that are focused on startups. Again, going to Silicon Valley and going into Kleiner Perkins, that's not going to work. Okay, these guys are looking for really large scale type opportunities. You need to target investors that are focused on startups and ideally with experience in your market. In your deck, explain how you will use the investor's capital. And what's often done is it's nice if you could put a couple of key milestones together. And I've seen cases where somebody says, I need 300,000 on a convertible note. The investor looks at it and said, oh, I see you're going to have a minimally viable product in 14 months. So how much is that? Somebody says, oh, it's 200,000 just for that. He said, well, of the 300, I'll cut you a check for 200 today. After you successfully show me the minimally viable product, I will then give you the extra 100,000. So often you might have to tie milestones to some key events to keep an investor attractive. And then also you're going to have to communicate with them pretty regularly as to how you're dealing with the milestones. Very important to forecast and defend your revenue estimates. Okay, customers are everything in this business. As I've said before, the strength of your story is on how good do you have, what is the quality of your independent TAM, SOM market forecasts. And any TAM or SOM absolutely positively must have a source. And frankly, that source needs to be big and prominent in the slide. It is an incredible badge of credibility that you can cite well understood third-party research. Show a path to profitability. You won't get there overnight, right? First thing you have to do is get a product, develop a product. The next thing you have to do is establish a recurring revenue stream. Once you've got all that at hand, then the next question is, okay, how are we going to make money? Well, you make money by selling something that costs less to produce than you sell, right? And again, no one is expecting you to be profitable from the get-go. And very often, early on, you may have to do prototypes and your cost of goods could be quite high. But early on, what you're trying to do is prove that there is a valid market for your product. Once you've established that, then cost of goods can often be fixed by simply going to offshore manufacturing. And again, the VCs can really help you with that and ultimately get you to a better place. So it's not unlike, it would be fine to say, hey, in 3 years, we're going to be 2% profitable, but to get to 30% profitable, we're going to have to lower the cost of goods by another, 50% or something. We believe that's achievable with XYZ high volume manufacturing. And lastly, if you're going to pursue a venture capitalist, you're going to have to have worked backwards and give them a valuation assumption. And that's very, very important for them to understand the size of their income. So, hey, that basically concludes the presentation. I was asked to keep it to an hour. Questions, comments, was this helpful? Anything you want me to repeat or go back? And I'll be here for the rest of the day, and I'm happy to share. And if you have, want to go drill down on some specifics as to how it might apply to your group, love to be a part of that. Yeah.
I had a couple of questions. Thank you so much for your presentation. The first thing I had is what do VCs prefer when it comes to convertible note versus venture, like Series A?
Well, mostly it's the dollar amount. First off, when you get involved with a VC, by the time you get their funding, they will have met with your first grade teacher. They do a lot of vetting. They do a lot of overhead, and that costs them money. And so they don't like to do structured agreements for small amounts of money because the overhead exceeds the actual value. So the convertible note requires a lot less vetting, but typically is somewhere around a $500,000 amount that they're comfortable with. But if you want to start to scale up and you get to, again, everything, there's an exception to everything I say, but probably when you start asking for $1 million to $2 million, $3 million, the venture guys might start to look at you and say, yeah, then we're going to vet, and the overhead would actually be a positive return. But it's the dollar amount, And as I say, the one thing I want to bring back is a successful crowdfunding round of financing is extremely attractive down the road to a future VC. Because it said, hey, I found 1,000 people that were willing to do this. And oh, by the way, I converted 30% of them to one-time customers. So that can be very powerful. But it often depends on the size of the money.
And one more question.
Yeah, please.
Slide, I think, where it's that sentence that you want to go out to VC with.
Yeah, sure.
Like I'll do, this much at 45 million with 22% equity.
Right here. So Team X requests 1 million. That's your seed money or your get started money in return for 22% equity. But what does that really mean? Well, that to give this, just to say you're going to give up 22%, 22% of what? Well, it's based on a fifth year valuation of 45 million. And a VC will look at this and go, oh, at the end of 5 years, I am going to get 22% of 45 million. That's 10 million. So they're promising me a 10x return in the fifth year. But there's a lot that they can decode in this statement. But this is how you talk to a VC.
So the main point of this is that they can be like, okay, this is a 10x if it works out.
Exactly.
Okay.
There's a lot of depth in that simple statement.
And so behind that, the 22%, is there a rule of thumb that you like to follow where it's like, I don't want more than 30% because then that's kind of a strangely high.
You're absolutely right. In Series A, I would say 15 to the maximum 30, but I really like something in the 20s. But when you start asking for a couple $1 million, you should be prepared for the VC to say, I'm going to put a member on your board from my company. And oh, by the way, I'm going to come in every 2 weeks for an hour, and I'm going to want an overview as to how the group is doing. How are you hitting your milestones? It is definitely a very involved relationship. Yeah. But if I've done one thing, if I can get you to think like this in front of a VC, you're going to be way ahead of most people. This will really get you there. Yeah.
Reading about that, obviously there are upsides and downsides. But with that, you don't have that obligation to give up.
Okay. So the question is, there are two ways to start a company, and one is debt, and the other is equity. And let me, in case you're not familiar, so debt is a loan. Now, very important legal perspective here. If I loan a company $1 million, and then at the same time, the company sells equity and gives equity out to shareholders, if that company runs on hard times and they end up going bankrupt, the debt holder will always be repaid before any equity, if there is anything left. So a debt instrument is the first person that receives any credit in the event of a bankruptcy. So from that point of view, you're ahead of the equity players. In this space, the problem is startups are going to be cash flow challenged. They always are. And so if you just say, I'm going to go take a loan for a couple $100,000 and I'm going to offer 10% with a 2-year maturity, it would be very hard when you start looking at the pro forma of the company to be able to pay all that capital back when you're still trying to get profitable, you're still trying to grow your revenue. Loans are very difficult to do unless someone's willing to give you a very, very long loan. And I don't think that's good for you or them. But technically, a loan does not require you to give up any equity. And so that could be attractive. But at the same time, they have a lot more legal power to enforce and make you pay back. And you could get in a situation where you've lent out, you've taken a loan for $200,000. 2 years have gone by, and you can see a path to profitability. It's beautiful. But that guy says, hey, I want my money back now. I don't want to hear it. You've got to pay them back. And you may not have the cash, or you may have to take all the cash and pay them back. And now you're back to square one because you're going to need money to go and fund the next development in your company. So typically, debt financing is not really the way to go. A convertible note starts with a debt, but it converts to equity. And I really think equity is the way to go because once you take on a loan, it's an encumbrance. It's something that you have to pay back. You have to pay that back before any other investors or any equity. And it leaves you in kind of a vulnerable position. Because again, I am not aware, I mean, I've done this for a long time. I've seen a lot of startups, and just about every one of them is a cash flow problem. I mean, until they really make it, they're living hand to mouth, and they don't have a lot of excess cash to pay back a loan when they're in the middle of trying to really grow the company. So that's my perspective. Yeah. Yeah.
Can you tell the students about the non-dilutive capital that they can access? Not the loan, but grants, SBA, winning the contest and all that stuff. Because a lot of people, when you start up at this stage, try to get lots of free money as much as they can.
Yeah. Now, to be honest, I'm not that familiar in that space, but free money. I mean, that's always the best, right? I mean, there's a couple things you can do. I mean, one side of it is some people will say, I'm going to try to go and start a nonprofit, or I'm going to try to help students. And you go the nonprofit route, and you can do crowdfunding, and then in theory, the people that are funding you, they can get a tax deduction, and you can do some things like that. If you're successful, and I've seen some good presentations from this group, and I wouldn't be surprised if one of you guys ends up taking the prize, so much the better. I mean, that's free money, and that's the best, right? I mean, to establish. And, but that alone, here's one way to look at it. If you were successful at winning $10,000, you would then want to do some very minimal work to show that you've made some progress using that funding. Now you've got even more credibility to go to a formal investor, because you say, hey, I've received this very early seed money through a program, and we executed X, Y, Z, and now we need X amount more to go to the next level. And that can be very compelling. But again, not an area of my expertise, but there is tons of available monies out there for young entrepreneurs. And by the way, some of the VC companies also have now small organizations that want to just foster entrepreneurship. And so definitely, you may look at someone like Kleiner Perkins or Sequoia. Yeah, they're not going to want to do a formal deal, but they may have a small group that does charity and types of work, nonprofit, for the betterment of students. Yeah.
I think many companies have venture funds also, which have very favorable terms if you can access those, if you're in that field, whatever field you're doing, and if there's a company that can have a connection, you can go there and get money from them.
Yeah, absolutely. Yeah.
There are a lot of secondary sources. Many of the smart startups try to get as much free money as they can.
Yeah.
Non-diluted. I mean, nothing is free, but non-diluted money.
And again, we're using terms that may not be familiar. Non-diluted. What that means is you get 22% equity in a company. You don't want that company then deciding they're going to put out another 1 million shares, and then all of a sudden the share pot is bigger and you get diluted. And there's something called a ratchet. A ratchet is what a VC will put in the term sheet that says any future rounds, I'm guaranteed not to be diluted. And now we're getting way down in the weeds and way beyond this group. But I just want to point out there's a lot of terminology in this space. And that's why, typically starting with crowdfunding or convertible note, much simpler to get going. Yes.
I know this presentation is eager to go to product or service kind of thing. There is another industry, other asset classes. How I know each startup company has a different purposes in this group.
Mm-hmm.
How they will treat these things, valuation aspect.
Well, I mean, the valuations determine the market sector, right? And there's a lot of information you'll see. You can start with public companies, right? And you can look at their PEs and get a relative understanding. Medical devices, pharmaceuticals, manufacturing. If you're in the business of making Oreos, you're going to have a much lower PE, and you're in the food business. It's a much different model than some of the other aerospace industries. But you really want to try to understand where you think your market, your ultimate destiny is, and who are some of your fellow travelers, and then use them to basically come up with a financial pro forma or a multiple that would hold together. And when in doubt, if you think the market's at 20 multiple for what you're doing, you should come in at 15. You know, never come in anywhere close to where the market is, because the market is a proven entity. You're a startup. So you're going to have to prove yourself, and you're going to get a smaller valuation until you make that proof. Okay. All right. Well, thank you.